Greetings, everyone! Welcome to House Lux Estate, your go-to channel for all things finance and investment. We're here to shed light on the often complex universe of finance, making it accessible and understandable for everyone. Our mission is simple: to empower you with the knowledge you need to make informed investment decisions. Today, we're going to embark on a journey of discovery, a journey that will take us through the intricacies of two popular investment vehicles: exchange-traded funds, commonly known as ETFs, and mutual funds. We'll demystify these terms, delve into their characteristics, and explore their pros and cons. By the end of this video, you'll have a better grasp of which investment might be the right fit for you. So buckle up and prepare to delve into the fascinating world of finance. Stay tuned as we dive into the world of ETFs and mutual funds. Let's start with ETFs, or exchange-traded funds. Picture this: a basket filled with a variety of goodies. That's essentially what ETFs are, but instead of sweets and chocolates, they're filled with a variety of stocks, bonds, or commodities. So, how do ETFs work? They're traded on major stock exchanges just like individual stocks. This means you can buy or sell them throughout the trading day at fluctuating prices. They're designed to track the performance of a specific index, sector, commodity, or asset class. For example, an ETF might aim to replicate the performance of the S&P 500. Now let's talk about some of the key characteristics of ETFs. First, they're known for their transparency. Every day, the holdings of an ETF are disclosed, so you always know what's in your basket. Second, they're usually passively managed. This means they aim to mirror the performance of an index rather than trying to beat the market. There are, of course, pros and cons to investing in ETFs. On the plus side, ETFs offer diversification. Because they hold a variety of assets, they can help spread your risk. They're also generally more tax efficient than mutual funds, thanks to their unique structure. And because they're passively managed, their fees are often lower. However, the convenience of being able to trade ETFs like stocks also has a downside. Every time you buy or sell an ETF, you'll likely pay a brokerage commission. Over time, these costs can add up, especially if you're an active trader. Also, while ETFs do provide access to a broad range of assets, they may not offer the same level of exposure to certain sectors or regions as some other investment vehicles. So that's the overview of ETFs. Now, let's explore mutual funds. Now, onto mutual funds, another popular investment vehicle. Mutual funds are, in essence, a pool of funds collected from multiple investors. This pool, managed by a professional fund manager, is then invested across a diverse range of assets, such as stocks, bonds, and other securities. The aim? To generate income or profit for the investors. Each investor in a mutual fund owns units, which essentially represent a portion of the holdings of the fund. One key characteristic of mutual funds is diversification. They allow individual investors to invest in a broad portfolio of assets, which might otherwise be out of reach. By spreading the investments across different assets, mutual funds can help manage risk. If one investment underperforms, others might do well, potentially balancing out the losses. Mutual funds also come with professional management. This means that someone with experience and expertise is making investment decisions. This could be a boon for those who lack the time or knowledge to manage their investments themselves. However, like any investment, mutual funds aren't without their drawbacks. One of the main ones is the fee structure. Mutual funds often come with a range of fees, including management fees, transaction fees, and sometimes a load or sales charge. These fees can eat into your returns over time. There's also the issue of liquidity. While mutual funds can generally be bought or sold at the end of each trading day, they lack the intraday trading flexibility of their counterparts, exchange-traded funds or ETFs. Lastly, while professional management can be an advantage, it can also be a disadvantage. If the fund manager makes poor investment decisions, the fund's performance could suffer, impacting your returns. So, mutual funds offer diversification and professional management, but they come with fees and lack the trading flexibility of ETFs. They can be a good option for those who prefer a more hands-off approach to investing, but they require careful consideration of the potential costs and risks involved. That's mutual funds in a nutshell. But how do they stack up against ETFs? Now that we know the basics of both ETFs and mutual funds, let's compare them. First, let's talk about the similarities. Both ETFs and mutual funds are types of investment funds. They both allow investors to purchase a diversified portfolio of securities in one transaction. This diversification can help to spread risk and increase potential returns. Both types of funds are managed by professional fund managers who aim to ensure the best possible performance. Now let's delve into the differences. One key difference lies in how they are traded. ETFs are traded on an exchange like individual stocks, meaning they can be bought and sold throughout the trading day at fluctuating prices. Mutual funds, on the other hand, are bought and sold at the end of the trading day at a fixed net asset value price. This difference can make ETFs more flexible, but also potentially more volatile. Another difference is in their investment minimums. Mutual funds often require a minimum investment, which can sometimes be quite high, making them less accessible for some investors. ETFs typically do not have a minimum investment requirement, making them a more accessible option for those starting out or with limited funds. The structure of the two types of funds leads to another key difference: taxation. ETFs have a more tax-efficient structure than mutual funds due to the in-kind creation and redemption process. This means that ETFs can have lower capital gains distributions, which could result in fewer taxes for the investor. Let's not forget about fees. Both ETFs and mutual funds charge fees, but the structure can vary. ETFs typically have lower expense ratios than mutual funds. However, because they are traded like stocks, you may have to pay a commission every time you buy or sell shares of an ETF, depending on your broker. Mutual funds, while they may have higher expense ratios, often do not have trading commissions. Lastly, transparency is another factor to consider. ETFs are required to disclose their holdings on a daily basis, providing a high level of transparency. Mutual funds, however, only have to disclose their holdings quarterly, which can make it harder for investors to know exactly what they own at any given time. All these factors can influence your decision when choosing between ETFs and mutual funds. Consider your investment goals, risk tolerance, time horizon, and financial situation. There's no one-size-fits-all answer. Each type of fund has its own benefits and drawbacks, and what works best for one investor might not work best for another. That's a side-by-side comparison of ETFs and mutual funds. But which one is better for you? So, ETFs or mutual funds? The answer ultimately depends on your individual circumstances. Investing is not a one-size-fits-all journey. It's more like a tailor-made suit, customized to fit your unique financial shape and size. The investment vehicle you choose should align with your financial goals, risk tolerance, and investment horizon. Let's delve into a couple of scenarios. If you're the type who likes to play it safe, mutual funds might be your go-to. They offer professional management and diversification, which can help mitigate risk. Moreover, if you're planning for a long-term goal, like retirement, mutual funds can be a steady ship sailing through the volatile sea of the market. On the other hand, if you're an active investor who enjoys having your hands on the steering wheel, ETFs might be a better fit. They offer the flexibility of trading throughout the day, like stocks, allowing you to respond swiftly to market movements. Plus, if you're keen on a specific sector, ETFs offer a wide array of thematic options, letting you invest in niche markets or emerging trends. But remember, these are just scenarios. There's no single right answer. It's about finding what works for you. Reflect on your financial goals. Understand your tolerance for risk. Determine your investment horizon. These factors will guide you to the investment vehicle that best fits your journey. Remember, the best investment is the one that aligns with your financial goals and risk tolerance. And that's our deep dive into ETFs and mutual funds. We've outlined the differences, benefits, and drawbacks of both. Remember, your choice of investment depends on your financial goals, risk tolerance, and investment horizon. We encourage you to delve deeper into this topic and consider seeking advice from a financial advisor. Your journey towards financial growth is just beginning. Thank you for watching. Don't forget to subscribe to House Lux Estate for more insightful videos on finance and investment. Until next time, happy investing!